Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Alibaba.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We have a really fascinating company here, one that's been going through this massive transformation.
Right.
And I think we need to cut through all the recent noise, all the volatility, and figure out if this is, truly the moment they emerge as a leaner, AI-driven powerhouse.
That is the central tension, isn't it? Because you've got this long history as an e-commerce giant, but everything we've looked at suggests the company is finally kind of shedding its old skin.
Exactly. Revealing a new and much more profitable core.
So where do we see that reflected first? What's the first data point that jumps out?
It's clearest in the financial results. I mean, they reported hitting nearly 1 trillion yuan in revenue for the full year.
Which is about, what, 140 billion in US dollars?
Roughly, yeah. A solid 5.86% year-over-year growth. But honestly, that top-line number, it kind of masks the real strategic shift happening underneath.
This is where it gets really interesting for investors. You see that revenue growth, 5.86%, and you think, okay, that's good in this climate.
It is.
But then you look at the net income, and it surged dramatically by a staggering 62.36%. That's a huge divergence.
Precisely. That 62% profit surge is the clearest signal yet that this massive multi-year internal restructure, it's officially over. They've been aggressively shedding those low-margin, sprawling assets and have focused ruthlessly on efficiency and the high-margin parts of the business.
And that explains the explosive jump in profitability.
It does. And that pre-tax margin of 15.1%. The business that's left is just far leaner and more powerful than the top-line number suggests.
It sounds like, discipline management finally prioritizing the quality of the profits over just the pure volume of transactions. So if they're shedding old assets, where's the new growth engine? Where is it coming from?
It is definitively coming from their high-margin engine, cloud.
Right.
We're seeing accelerating growth in this sector, reporting, 26% year-over-year net sales growth for the most recent quarter. This segment is just so strategically critical.
Because it's the foundation for all their AI stuff, right?
It's the foundation for everything. Their entire future technological dominance rests on it.
Okay, 26% growth is solid. I get that, especially at their scale. But let me just play devil's advocate for a second here.
Go for it.
When you look at some of the U.S. cloud peers, some are still reporting, 35, even 40% growth. Is 26% actually a sign they're maybe losing a bit of market share, or is this just the natural pace for the Chinese market right now?
That's a really important question. The analyst's view on this is that the 26% figure reflects stabilization after a period of, really intense price competition.
Ah, okay.
What's fascinating here is that the margin quality in their cloud segment is improving dramatically. This suggests they're moving away from just chasing low-margin government contracts.
And focusing more on higher-value enterprise customers.
Exactly. The ones who will use their advanced AI tools. It's a quality over quantity story in the cloud, mirroring the whole company's restructure.
Speaking of foundations, this whole transformation wouldn't really be possible without a safety net, and their financial stability it's remarkable.
It is.
We're talking about a fortress balance sheet here. Total assets around $250 billion, huge cash reserves, and really robust free cash flow.
And this financial strength is what underpins their whole competitive moat. You really can't overstate the extent of their ecosystem. They are still China's dominant player in e-commerce and cloud, and it's all supported by these sprawling logistics, payment systems, and just immense data networks. It creates such a high barrier to entry for anyone.
So the money is sorted, the foundation is stable. Now, how do they make sure that money translates into sustained dominance in the next tech wave? Which means we have to talk about AI.
Absolutely. Their AI leadership it's central to the whole investment thesis moving forward. They didn't just go out and buy a few servers.
No.
They developed their own Qwen AI models, which are now, seen as genuinely competitive with the leading U.S. and Chinese alternatives. They're positioning themselves not just as a consumer platform,
but as the underlying infrastructure.
The underlying infrastructure layer for the next generation of Asian tech.
And we're already seeing this AI capability translate into tangible, almost unexpected growth vectors. I mean, the NBA-China partnership is a perfect example.
It's a great example.
This isn't just about slapping a logo on some merchandise. They're using the Qwen AI models for new sports tech initiatives. It really boosts their profile in entertainment tech, especially as the NBA's relationship with China gets back to normal.
It's a very shrewd move. It allows them to pilot new AI-driven user engagement tools on a massive, highly visible platform. It's proof that the R&D investment is immediately being used to drive new revenue, not just, internal efficiency.
So when you put all these pieces together, the disciplined profits, the fortress balance sheet, this accelerating AI story, it makes sense that institutional confidence is so high.
It does.
We're seeing consensus strong buy ratings with an average 12-month price target suggesting, what, over 21% upside from where it's been trading?
Yeah, and that conviction, it shows up vividly in the price action itself. The stock has seen a really robust momentum reversal this year, which just confirms that strong investor interest is back.
It has been a powerful run, up nearly 96% year to date and over 40% in just the last 3 months. So let's turn to the technicals for a moment. For those who don't watch these charts daily, can you walk us through what the numbers are telling us about the health of this run?
Of course. So if we look at the trading range, the stock is currently sort of fluctuating between about $152 and $166. The critical resistance level is $170.55.
And the clean break above that would be the trigger.
A clean breakout above that is often seen as the technical trigger for the next major leg up.
Yeah.
But yeah, the health of the move is crucial.
And what are the indicators saying? Is this a speculative spike or is it sustained accumulation?
They look pretty healthy. The relative strength index, the RSI, is sitting comfortably at 42.94.
So not overbought.
Exactly. This is important because it means that despite that massive jump, the market isn't technically overbought. There's still room to run. On top of that, the stock has a very low beta of 0.32.
A beta of 0.32 suggests this stock is kind of oddly insulated from the broader market moves, right?
That's exactly it. It implies that when the S&P 500 moves 1%, this stock typically only moves about 0.32%. This suggests the momentum is being driven by sustained buying based on company-specific fundamentals.
Like the AI news and the restructuring finally paying off?
Rather than just speculative spikes tied to whatever the broader market is doing that day.
That paints a very, very optimistic picture. But we always have to address the elephant in the room when we're talking about this sector.
The risks.
The risk factors. Despite all this internal momentum, what is the single biggest external threat that just continues to weigh on the stock?
Oh, it's regulatory scrutiny, without a doubt. It's a persistent and multifaceted threat.
And it comes from both sides, right?
Both sides. Whether it's ongoing U.S.-China tensions over technology and data, or from Chinese policymakers tightening domestic control over data privacy, the need to constantly adapt to policy shifts remains the primary overhang.
And how does that translate into a real-world financial impact? Because we know the company has adapted, but why does the market still pair so much?
It creates a permanent valuation discount. Investors just apply a lower multiple to the earnings of Chinese tech giants compared to their U.S. counterparts, precisely because the regulatory environment is less predictable.
Right.
We've seen specific actions in the past, like massive data privacy fines, that remind investors that this policy risk is very real and can hit the bottom line at any moment.
But this regulatory uncertainty seems to collide directly with their intense investment strategy. We know the long-term AI growth story is strong, but all that heavy spending, specifically in instant retail and, developing those AI capabilities, that prompted some concerns back in October about near-term profit pressures. It's the cost of staying ahead.
And that caution triggered some of the recent volatility. We saw an influential AI analyst actually downgrade the stock to hold, citing those exact near-term profitability risks.
And that had a real impact.
It coincided with a 3.9% single-day stock drop in November. It just proves how sensitive the market is to any hint of margin compression, even if it's for a good strategic reason.
So investors are weighing this long-term AI dominance against the short-term cost and that perennial regulatory risk. Fortunately, the immediate future is packed with potential catalysts that could break that stalemate.
It really is.
What's the most immediate trigger we should be watching?
The Q3 FY 2026 earnings report on November 20th. This report is expected to show really robust year-over-year growth, especially because it's going to benefit from that massive Super Golden Week retail surge.
So strong numbers there will quiet the talk of near-term profit pressure.
It should. It would confirm the strength of the restructuring.
And then right after the financials, we get the tangible operational catalyst, the full rollout of the NBA-China partnership.
Yes, this is when we actually see the new AI features powered by Qwen get launched, probably late November or early December. This is where the AI investment starts to prove its worth in user engagement.
Structurally, investors also need to keep an eye on institutional flows, right? There's an ETF rebalancing coming up.
That's right. The stock is expected to be included in a major ETF rebalancing in early December, and shifts in index weighting can drive significant, even if they're temporary, price swings as all the passive funds have to adjust.
Okay, finally, let's connect this to the bigger picture and some of the high leverage rumors. We're hearing speculation that the NBA partnership could expand beyond just tech and into full e-commerce integration.
Yes, which would leverage their massive logistics and cloud infrastructure. And that ties into the other persistent chatter, which is about accelerated international cloud deals, particularly in Southeast Asia and the Middle East.
And if they can successfully export their cloud and AI tech internationally?
It provides a powerful counterbalance to that domestic regulatory uncertainty. These rumors suggest there's still a lot of untapped growth out there.
So you have a company with fortress financials, world-class AI models, and a calendar full of clear near-term catalysts. The investment narrative has really shifted from risk mitigation to growth acceleration. The question for you, the listener, is this. When fundamental growth accelerates this fast, is any amount of geopolitical noise enough to stop the momentum, or does every single dip simply become another buying opportunity?